All right. Hello and welcome. My name is Todd Federman, and I am the Managing Director of North Coast Ventures. Today's event is put on in partnership with the Angel Capital Association. For those of you not familiar with the ACA, they are the trade group which represents several hundred angel groups, along with over 10,000 individual angel investors across the world. North Coast Ventures has been a member of the ACA since we were founded 13 years ago. For those of you not familiar with our group, North Coast Ventures, we're based in Cleveland, and we're made up of over 250 individual investors in 6 separate funds. The funds include both angel funds and more traditional venture capital funds. We've invested in 59 startups, with most of them being seed stage B2B software as a service ventures. We feel that our strongest asset is the power of our network, which we believe also extends to help companies succeed at the board level. We're thrilled to have over 200 people registered for this event, and there are 3 general frames which we hope will be a reference point for all of you as attendees. Number 1, current and potential board directors and observers. We hope you'll expand your perspective based on best practices collected from hundreds and likely thousands of board experiences. Number 2, individual investors that, although you may not anticipate serving on a board, you may be part of a group like North Coast or an individual investor where you stand to gain a better appreciation for the role of a board to better assess companies as you consider potential investments. We hope it will help you understand if a given board for a company is up for the challenge, and we also hope it'll help you understand if a given CEO is likely to thrive with a board environment. The last lens is that of a CEO. Our intent is to be painfully transparent here and share the playbook that we expect seed stage directors to bring to the table. After seeing this, you may be more comfortable raising capital and taking on a board, or you may decide that this isn't for you and you'd prefer to bootstrap. Either way, that's okay. Most of the focus today will be on startup boards. These are often seed stage companies that are past the friends and family stage, but pre-institutional venture capital. This stage for a board is a very different animal than a venture capital board or a private equity board. The goal of a company at this stage is typically to enhance the initial MVP, prove out the value proposition, and demonstrate early signs of product market fit, which will of course be necessary for success at the next level. The goal of a board for a company like this is to establish proper governance, help support the team, and keep the company out of trouble. This is a tough stage for companies and their boards. Most seed stage startups will fail. Even with a great board, you cannot will a company to success. That said, a great board can help create the necessary conditions for success by operating in a way that ultimately gives the CEO and her team more time, more space, and more capital to do what matters most: building a great team, demonstrating product market fit, and attracting enough capital to scale. Before we get started, I'd like to thank PNC, our sponsor for the event and our sponsor for the full 2020 Investor Insight series. As many of you know, PNC has a strong commitment to economic development and the entrepreneurial community, so it's a natural for them to support an event like this. Over the past several years, I've gotten to know Pat Pastore, PNC's regional president, as well as John Beer and Dave Leger, who lead the PNC Wealth Management and Hawthorne groups. I can't say enough about their support and their partnership which they provided to North Coast. Please know that I'm always happy to make an introduction if you have any questions about the bank or personal wealth management. As I get ready to turn my video off and hand off to Ram, I wanted to let everyone know that the Q&A feature is active. Feel free to post your questions and they will be addressed at several different breaks along the way. Thank you for joining us, and take it away, Ram.
Thank you very much, Todd. I think you pretty much gave my presentation for me in terms of what boards do and why they're important. That was an eloquent and spot on. I'm going to now share my screen. So it's a pleasure to be back in Cleveland. In fact, this presentation has its genesis in Cleveland. My daughter was in law school at Case Western, and I would fly out every semester to kind of prep her for her final exams. Although I'm not a lawyer, I can read really, really fast. And I became fascinated with the whole venture board thing, having served on them myself for many years. But this allowed me to really become more structured in how I thought about boards. presentation today is the Angel Capital Association's official curriculum on boards of directors, which I've had the pleasure of authoring. Again, it's really great to be back in Cleveland. You will get copies of today's slides. What the Angel Capital Association, on whose board I serve, does, we produce reports on who angels are and how they invest. We represent angels in DC and have done some really good things about things like not changing the accredited investor rule, preserving certain exemptions. We also do lots of education, like today, on things like boards, due diligence, cap tables, and we are the pretty much we're trying to be the gold standard for data about angels. About me a little bit, the reason I'm here is because I've served on at least 40 boards as chairman or director. I've been an angel or a VC for the past 20 years and have done lots and lots of mentoring. My favorite thing to do in the world is mentoring startup CEOs. So it's great to be here. One caution, today's presentation is equal opportunity insults. I'll be having some tough comments about board members. I'll be having some tough comments about CEOs and service providers in the interest of full disclosure. I remember that the world's first Protestant, Martin Luther, used to complain about the Catholic practice of confession because he said, by listing all the potential sins you may have committed, all we're doing is educating young people in how to sin. Well, the CEOs on today's call, I'll be educating you as well about things you might do, which we as directors might hope you wouldn't do. So please bear with me. As I said, there is something in today's talk for everyone. The focus today is early stage boards of directors and governance, and it's never ever too early to become informed about your role as a board member, particularly around things like fundraising, like governance, and even M&A, as even in a company's first year, someone can swoop down and say, we want to buy your company. And at that point, what's the role of the board? So the goals today are to understand startup company basics, understand our legal duties and obligations, maximize our effectiveness, focus on the CEO's role and how to manage that role with the board. Above all, stay out of trouble, because there are many trouble zones that can harm directors, harm boards, harm companies, and my goal is to keep us all out of trouble. Make sure you're still awake. We're going to be talking about zombies, about why good board meetings are like nuclear arms treaties, the difference between being a coach and a cheerleader. What does NIFO mean? What's the risk of being a board observer, just sitting there? And finally, what is the red zone? So, introduction to board basics, roles and duties, and the changing nature of the board over time. So what's a board? It's a group of persons jointly elected by the shareholders to govern the affairs of a corporation. It is the combination of the office of the presidency and the Supreme Court, the highest governing and executive authority for a company. The board is typically established. If you're a C corporation, you are required to have a board. While the rules differ by state, the rules for the board are found in the company charter and the company's article of incorporation filed with the state. All you need to do in the company charter is to have a name, some stock, some officers, some directors, and some bylaws. That's it. Every time you raise a new round, you must change the articles of incorporation because your capital structure has changed and potentially your governance structure as well. For investors in the room, remember one thing: you will never have more leverage in terms of impacting corporate governance, building good governance, than you do at a financing round. Because the typical financing round specifies in its closing documents not only how much is going in, but changes to corporate governance. So as directors, familiarize yourselves with the articles of incorporation, including the bylaws, the investor rights agreement, the term sheet, and the cap table. If you do that, you'll have all the information you need to know about how the company is governed. Duties of the board. The top couple I'd like to mention are defining the company's mission, its purpose, its culture, how it operates, hiring and firing the CEO, sometimes other executives as well, supporting and mentoring the CEO, which includes performance reviews. And then we plan, we assure adequate resources, we make sure the resources are used well, we reduce risk, we serve as a court of appeals. And the best boards do an annual 360-degree review on their own performance by talking to management, by talking to employees, by talking to customers about how is the board doing. Now, as companies begin to scale beyond the Series Seed and move into Series A or Series B, issues become a lot more complex. You deal with things like you're always financing, so that's one major thing. You have, as Todd said, you need to understand product market fit. That's one of the things that we angels help you do. Well, supposing that product market fit is close, but not exact, you may need to do a strategic pivot. During certain economies, you may need to worry a lot, like we did up until this year in Silicon Valley, about employee retention. You're always worrying about lawsuits, particularly after your product is launched. You gain customers, maybe patent trolls out there gunning for you. The board needs to worry about any kind of a contract that in any way reduces the flexibility of the company to sell to other parties. You'll be moving into bigger facilities. You'll be signing expensive long-term leases, or you used to before COVID. You may be approached for M&A. The board establishes compensation policies. The board worries a lot in areas like healthcare and finance about regulatory compliance breaches, which can cost companies hundreds of thousands up to billions of dollars if you're a large player like an Equifax. We manage conflicts with competitors, and when it's time, the board is responsible for managing exits. So if you look at the role of the board over time, for all boards, early, middle, and late, we ensure a high quality governance. We hire the CEO, we approve executive hires and compensation, we approve plans on an annual basis. The most important thing we do at a board meeting is monitor performance against that plan. We hire law firms and audit firms. We approve compensation and build a compensation framework. And we ensure that the board is talking to its shareholders at least on an annual basis. As you go beyond the MVP stage, beyond first customer and start to scale, put your foot on the gas, we approve contracts. In a number of cases, which I'm sad to mention, where we've had CEO and or executive team meltdowns, the board has taken over to be the operating office of the CEO. We approve financing, both debt and equity. Anything that changes the capitalization structure of the company comes before the board and eventually the shareholders. If we have dividends, which is something I've only seen once in the 60 or 70 companies I've worked with, if there are dividends, we approve them. We protect IP. We ensure that we're in compliance with various laws. We have a nominating committee and we do our own review. We're in the middle of acquisitions and exits. Now, during time of exits, it's the board, not management, that hires and selects the investment bank or the law firm managing the process. It's up to the board to approve M&A deals or to prepare and execute IPOs, which is usually at least an 18-month process. And in bad situations, we also ensure wind down, liquidation, in most cases what's called an assignment for benefit of creditors, an ABC process. And the board assures that all of this is handled to the interests of debt holders as well as shareholders. Once you've accepted venture capital, the whole world changes. When you're an angel-backed company or angel director or CEO, what's really important is the wonderfulness of the vision, the powerfulness of what could be. During this point, the CEO is equal to the board in terms of authority, moral authority, influence. The board is small. The focus of most board meetings is on how is that product going? How is that MVP coming along? How is that market testing going? How are we doing hiring? How is engineering holding up? The goal, of course, of every board and at every stage of the company until profitability is raising the next round. And the next round requires, for an angel stage company, validation of the products and some early customer wins to show that somebody besides your mom likes your product. And we call this period a honeymoon. We're in love with each other. Things are going great. We're full of confidence. The minute you bring a VC on board, the story changes to metrics and milestones. Most VCs, in terms of the agreements they've written with their investors or limited partners, say they will never invest in a company that they don't have with the other investors effective control. So power legally shifts to investors. The board increases with more investors. And the meeting is no longer about how brilliant the product is going to be. It's drill down reporting about what's exactly happening in the market with sales, most importantly. Where's cash? In terms of the next round, what you want not is just a great product, but you need to validate the business model assumptions of things like pricing, target markets, the efficiency of the sales force, and are you approaching scalability? Can you do the same thing over and over and over again? And as you move from an angel-backed company to a venture-backed company, you enter a real danger zone because all bets are off about the chemistry, and the VC is going to be very much focused on performance and very unforgiving when performance doesn't meet plan. So the most important tasks for an angel director, as said eloquently by my buddy John Houston of Ohio Tech Angels, is never run out of cash. Remember that we hire and fire the CEO. And since 95% of all exits are M&A, not IPO, we always have to keep our eye on the ball. The ultimate objective for investors is to return capital. How are we doing in thinking about selling the company? So with that, I'd like to turn it over to Daniel. Daniel is the director of North Coast Ventures. So Daniel, over to you.
Thank you, Ron. I'd like to also ask if all of our panelists could turn on their audio and video as I introduce them, as well as introduce this discussion section. So as you saw in the agenda, there are 4 sections to Ron's presentation and 4 breaks when we will check in with our impressive panel. And so allow me to just briefly introduce our panelists, starting with Clay Rankin. Clay is one of our managing directors at North Coast Ventures. He is the original managing director of North Coast, going back to when we began our first fund 14 years ago now. He has been investing in companies since 1988. He's been investing full-time with a partner since 1996. And Clay is also on the National Angel Capital Association board. Next, we have one of our very favorite investor members and entrepreneurs, Charu Ramanathan. She brings a very current and unique perspective from both sides of the table as a founder, CEO, and board member. And finally, we have Todd Federman, our managing director of our active Seed Fund 4, as well as Acceleration Fund 2. And he has been at the helm of North Coast with Clay over these last 14 years. And safe to say, he has seen a lot over those years. So as a reminder for all of our attendees, the Q&A section is open. We will continue to monitor Q&A. However, we've only allocated about 5 minutes for many of these discussion sections. So we do plan to address additional unanswered questions as a follow-up to the event. So we plan to send a communication out to attendees, and we plan to address some additional questions in that communication. So as I start the clock here on our end, again, we've asked each of our panelists to target crisp, roughly 60-second, 1-minute responses to our question prompts to keep us on track. And we'll ask just that one of our panelists answer each of the questions that's directed at them. So we'll start with Clay. So Clay, for the deals that you see, that you have seen, tell us about your experience. Are there typically boards in place prior to the investment, or is that something that you normally can find yourself helping to set up as part of your investment?
Well, welcome everybody. I think this will be a little bit of a generalization, but as Ron talked about, the focus here has been primarily on seed funding, outside seed funding, which is typically the first outside round for our startup ventures. And I would say that our boards are generally not fully in place. I think in the chart that Ron showed, you saw that the typical seed fund has 5 board members. Usually one, sometimes 2 of those are the founder or co-founders. 1 or 2 will typically be the funders, and usually the lead funder of this funding is sometimes another party that's part of that funding. And then finally, there'll typically be an outside independent director, and that person is, in my experience at any rate, often not yet in place. And so it really is a wonderful opportunity for us as board members to help the management team think about what expertise, whether it's market expertise or functional expertise would be most valuable to the company at that stage, and help them find that person, that 5th person, and bring them on board. So as a quick statement, I'd say that's been my experience.
Great, thank you, Clay. Charu, so how often do you feel the founder or CEO does not have experience, either engaging a board of directors or serving on a board of directors? And part 2 of this, if that's the case, what, in your view, should the founder or CEO do to really optimize their use of the board of directors?
Right. So I think there's, so if it's an inexperienced founder or CEO or a founding CEO, usually it's very hard to think organically about a board, because as you are being the chief cook and bottle washer of the company, a board provides a level of formality that you may not be able to have time for, right? So we have so many things. You just have an idea, you want to, convert that into reality. You're probably coding yourself. You're raising money. You've got so many things. And one of the things, and at least I've seen in entrepreneurs here that have reached out to me for some advice on the side was, hey, I have this investor, they want to put $100,000 or $250,000, but they want to be on the board. I want their money, but I don't think they're the right people, right? You hear this a lot. So, so one of the terms that, as a founder, that gives me a lot of, I'd say, irritation is boards fire and hire CEOs. Like, why would you state the obvious? That's a cultural bomb to start there, right? So when new CEOs hear that, that's what they're saying. I'm hiring my undoer here, so I should be very careful, instead of really thinking that they're not here to get rid of me or hire me. I'm here because I'm the founding guy. I'm doing all this work, and now I'm going to put somebody in place that's going to hire or fire me. Makes no sense. Instead, I would advise most CEOs to really say, why don't you be a mentor to me? Why don't you give me an hour of your time every week? Let's work together. Let's see culturally if you are a fit. And for me personally, I will never give up a board seat as a founding CEO without knowing that person first. So it is a position to be earned, and it cannot be bought with dollars.
Thank you, Charu. Next, Todd. So Ron mentioned that one of the key responsibilities of the board is hiring and firing the CEO. How often do you find yourself in that position? And is this something that happens, roughly 10% of the time, 90% of the time? I think this is a nice connection back into some of Charu's comments.
Yeah, and at the risk of contradicting myself, I'll give you 2 answers. The first is that individual investors and seed stage VCs almost never go into deals thinking that the CEO will need to be replaced in the near term. The most crucial thing we look at is team, and the most important part of team is the CEO. So if someone believes that the CEO is not the right person to lead the company, they should really just pass. That's the best reason to say, no, I'm not comfortable making an investment in this company. That said, and with some experience, we know that plan A doesn't always work out. But whether things are going well or going badly, directors do have the duty to evaluate the performance of the CEO and sometimes to take action. Sometimes the conclusion is that the company would just be in better shape if there were a different set of hands on the wheel. We try to avoid that, but to answer your question directly, I'd say it's about 10% of the time for our group, but mileage can probably vary depending on whether you're an individual angel, a VC, and what region of the country you're in.
Okay, great. Thanks, Todd. I don't think we have time for any additional questions. So I will turn it back over to you, Ron, and I believe now our panelists can turn off their audio and video.
Just want to amplify the last comment. When you are doing early seed stage and you have an engineer CEO, you may both agree that the most important thing is getting that MVP done and getting it into the market. And at that point, you may say, we're going to look and see your performance and see if it makes sense to bring in a CEO or a president who is more business oriented, more around sales, growth, business operations. And that is not unusual for tech CEOs who are technologists as opposed to business people. But that conversation happens before the money goes in, and you establish some progress points along the way. So we're going to talk about building a board and running a board. Early stage boards are defined in the financing round. The typical early stage board is typically 3 members. It's often 2 founders, 1 founder and a CEO, and 1 investor. When you get to Series A, it's typically 5, usually 2 from management, 2 from the investor group, and 1 independent. Remember that board services is a risk. It's a risk to you personally, it's a risk to you financially, reputationally, and it's a major obligation. It is not an honor badge. Wow, I'm serving on a board. If that's the attitude, don't go on a board because you just may not be the right choice. And remember that if a board meets once or twice a month, plus lots of mentoring, and the typical board meeting is 2, 3, 4 hours, this can easily consume, a single board can consume hundreds of hours a year. The earlier the board company, the more hours you typically spend. Now, best practice for startups is to have an advisory board, which may be around product or maybe around market. That has nothing to do with a fiduciary board, which is the legal entity responsible for the care of the company. So don't confuse advisory boards with boards of directors. I see it all the time. And I see people who thought they were advisors suddenly potentially having risk of an actual board that governs the company. So be very careful about that. As Charu said, the person who writes the biggest check or who leads a deal may not be the right person to take the board seat. It's often the case that by default that person does become the board member, but I would urge you to think very carefully. First of all, it's the investor group, it's not the deal lead who selects the candidate. And that deal lead is not always the right candidate because what you want from a board member is really strong industry knowledge. You want that person to introduce the company to potential partners or customers or employees. You want that board member to know something about governance. And most importantly, you want the board candidate to be objective and tough as necessary. And deal leads often go native. They often fall in love with the company, which is why they're leading the deal in the first place. They've lost their objectivity. And as we all know, love is blind. So our role is to be a coach. And that means to give love as well as tough love, and above all, honesty based on our experience with other companies and our overall good management sense. So be a coach, not a cheerleader, and pick the right board member from within the angel group and friends of the angel group who has industry knowledge, who is objective, and who can add a lot to the board in terms of networks and contacts. So why do you want to serve on a board? I think serving on a board is one of the most important things an angel can do. I know that my group, the Band of Angels, which is America's oldest angel group, we often say that our work starts when we write the check. So good governance is essential to protect us as investors. It's essential to mentoring a company's growth and success. Many first-time CEOs don't know what success looks like. They don't know what it means to run, for example, a marketing organization if their background is engineering. So it's our goal, it's our opportunity to let them know what success in all of the different factors, from marketing through customer success to engineering, means to them. So we do a lot of mentoring, and we often do a buddy system on the board where a board member will take 1 or 2 members of management under his or her wing. We share best practices, and so in this way we can make a tremendous difference between success and failure. I've also seen bad boards make all the difference in killing a company. The classic case is the case study for this session of Theranos, where a bad board was responsible for the complete collapse of a company. What happens? How do you actually become appointed to the board? Well, the investors pick their directors. So we are preferred investors at Series Seed. We get to nominate our director with, of course, the concurrence of management. Normally, board members are elected annually by shareholders, and we're eligible for re-election. Bigger boards often stagger board memberships so that you're coming on or off the board, new members every 3 or 4 years. Independent directors who are not responsible to a given class of shareholders. Independent directors, no Series A, no Series B. They are selected jointly by management and by investors and serve a very special role I'll talk about in a minute. You also want to have a way to get rid of directors who are not performing. And it's usually something like a 2/3 vote of the board can eliminate a director who is not performing or is becoming abusive or obstructive, which I've also unfortunately seen. The board chair is an optional role. There's nothing in a charter or bylaws that says you must have a chair. But often good board organization has a chair serving as a mentor, resolving conflicts, managing the board's process, managing the service of committees, keeping the agenda, and so forth. Best practice is the chair should not be the CEO and should not come from management. You want an independent source of wisdom and gravity so that all the power is not consolidated into one position. And of course, no cronyism. Very important role are independent directors. And even with a 3-person board, I personally like a member of management, typically the CEO, an investor, and an independent. That independent is the one who's all about the markets, maybe knows something about governance or regulatory compliance, but provides the board with deep expertise. One of the most important roles of a director who is independent is to be independent and to write what's called a fairness opinion. You will often have conflicts on the board where the only investor who wants to put money into a follow-on round is an existing investor, at which point this may be viewed as being unfair to other non-participating investors, particularly if it's a down round. So in situations where there's potential conflict, potential shareholder disappointment, you often ask the independent director to write a fairness opinion, basically saying, this was the best option on the table. We had no other options. Therefore, we're recommending going forward, and we think it's fair. And this is particularly for follow-on financing or for not great M&A deals where nobody is doing well, but it's best deal and you need to exit. So why do you, pardon me. So selecting independent board members, that person is not aligned with any class of shareholders, so is truly independent, has many kinds of expertise, may not serve for more than a couple of years. The continued service of the independent depends on continued relevance. So, as you're getting your financial operations up to speed, it may be great to have an ex-CFO serve as an independent director. But once you are a more mature company, you may need a different kind of independent. So, also very important is the person needs to have time to serve. There are a number of people who make a career out of being board independents. You need to make sure they're not on more than 4 or 5 boards. Otherwise, they will not have the time for you. So what's a board observer? Many boards have board observers. It's usually a right given to minority investors or strategic investors. That is, if you have an IBM or a Johnson & Johnson or a Cisco that's invested in you, let's say you're Series B, you may, that group may want to observe the board. So there are many situations, for example, angel groups that are no longer as strategic as they once were, maybe in a Series B or Series C, may be granted an observer right to stay engaged. So the role of the board observer is to understand how the company is doing. But the rule here is listen more than speak. You will have limited information rights. So if you are, for example, a strategic, you won't get access to sales statistics, sales visibility, or pipeline. You don't attend a closed-door executive session. For those who are, pardon me, those who are observers, be aware that you have all the liability of a regular board member, but none of the protections. So if you are viewed as having a decisive role in determining company strategy, even though you're an observer, you can be sued by any aggrieved party. So you have the same liability as a normal board member, but you don't have company indemnification, and you're not covered by D&O insurance. So be careful, be intelligent, be helpful, but don't be too active. So an effective director understands governance, understands the fiduciary roles that are played by board members, and obeys the NIFO rule. Keep your nose in, but your fingers out. Be aware of what's going on, be fully informed, but don't try to micromanage. Please use your market domain experience. Disclose any conflicts you may have, and we all have conflicts. The minute you realize you can no longer serve as a proud ambassador of the company, it may be time to step down. And of course, you use your business network to grow the company for hiring, for customers, for partnerships, even for exits. So an effective director doesn't just show up at board meetings, but is always thinking about ways to advance the interests of the company. There will come a time when you may have to decide if you stay on the board or not. Let's say it's a Series B or a Series C. The company's growing fast. They're taking lots of capital. They may be expanding internationally. They may now have an international focused VC on the board to help expand into Mexico or Canada or the UK. Keeping your board seat will protect your rights because you're right in the boardroom, and when there's horse trading about things like exits or financing rounds or cram downs, you're right there to protect the interests of your angel group. Also, when you're asked for a re-up or financing, a board seat's the best way to understand not CEO spin, but what's actually going on, the true status of the company. But as the company matures, you may be less relevant because the issues are no longer about early market acceptance or MVPs or first customers. They're now about international expansion, multi-product lines, partnerships with market makers. So your board seat will become vulnerable to a restructuring at a future financing round. So how do you keep the board seat if you truly believe you and your angel group are still relevant? Well, number one, bring in the potential next round VC investor. They'll be obligated to you. They'll already see your value. Two, if you're the mentor that the CEO most responds to, you're likely to keep your board seat. If you're the best voice around the table at a deep industry domain knowledge, that's a great way to remain on the board. And if you're viewed as gray-haired, as an experienced director with lots of value add, you may keep your board seat. And finally, if nobody wants to irritate your angel group because your angel group is deep into syndication with the kinds of next round investors that are now funding the company, that again, and they want to keep you as a friend, that's another reason why you may keep your board seat. But make sure it's strategic to you, make sure it's still relevant to you, make sure you're still adding value, and make sure your angel group still wants that board seat. Compensation, no cash, and a typical angel beyond what the angel is personally invested may get 1/4 to 1/2 point of equity for that board service. VCs get no compensation. Independents and directors who are appointed by VCs, sometimes VCs appoint directors who are not VCs because they're just too busy. The same thing, 1/4 to 1/2 point of equity. If you are not management but are chair, you may get 0.5 to 1%. And later stage, we're talking Series D, Series Z, the company is expanding, you have a real operational role. That's usually equity plus some cash, fees per month or per board meeting. But for early stage, don't waste precious capital paying board members. Structure of a board meeting, it's run by the chairman or CEO. It starts with the CEO's report, follows with a report on financials, comparing results to annual plan. Then you have departmental updates. You may have one update per meeting, or you may have all the departments give you a brief update. You may pick one strategic issue, like should we be moving to a larger facility, or IBM wants to partner with us, but they'd like an exclusive. So that may become the strategic issue for that month. You have a closed session, directors only, to do the mechanics of the board, minutes, resolutions, stock option grants, and then always have an executive session, outside directors only, no management in the room. Why? Because this is your chance to look at governance issues, and it's your chance to structure feedback for the CEO. One member of the board is usually delegated to do that at the end of the board meeting. So executive sessions are extremely important. Well, what's in the board package that you should be getting before the board meeting? The CEO's report, standard financials, most important is P&L and cash flow. Over the course of the first 4 or 5 months of a board, you will define an operational dashboard, what you measure at every board meeting. And it's typically actuals against plan. It may include the comparison of quarter-to-date plan versus the actual or year-to-date, or for companies in multi-year operations, last year versus this year. You will find and track key metrics. If you're a SaaS company, you will obviously be tracking things like churn. You'll also be monthly contract values, things of that sort. You'll have operational updates in the package. You will have risk and compliance issues identified in the package, subcommittee reports, board minutes, and approval of option grants. This is the flow of a board meeting, and it's also the flow of the board package. The CEO's report, important news, performance against plan, a high-level summary of all the issues in the board meeting, update on fundraising, update on the competitive landscape. And as I've said, over the first few months of the board will help the CEO define what's in the CEO's report and the board dashboard. So what we want in a board meeting is an accurate view of the company's current status and its going forward risks and strategy. So balance that view through the rear view mirror about what happened in the last period versus the windshield. Where are we going? If there are deficiencies against plan, work with the CEO and remediation plans to fix those deficiencies. The common rule for a good board meeting is no surprises. A good CEO should pre-brief board members on several things. Any negatives that will be revealed at the board meeting, and what the CEO wants at the end of the board meeting. What is the goal of the board meeting? What decisions should have been made? So a good CEO will pre-brief board members so they can think about issues, but you don't want to walk into a board meeting to learn that the VP of engineering quit last week. You should have heard about that last week and be strategizing with the CEO as to what to do about it. This bombshell shouldn't be dropped on you at the board meeting. This means, in practice, review financials, compare performance against plan, advise on strategy, and so forth. You should also be aware that as the Supreme Court of the company, you should be open to concerns from any stakeholder. As I mentioned, arms treaties before, you should be ready to believe what management is telling you, but question thoughtfully. And if the issues are tough, trust, but also try to verify. What you don't want to do, particularly those of us who have been CEOs or VPs of sales or marketing or engineering, you don't want to micromanage operations. That's not our job, but our job is to question thoughtfully. My friends at Ohio Tech Ventures typically say these are the kinds of questions that angel directors should ask, with the bottom line always being is this positioning us for growth and an exit? Are each of these things positioning us well to ultimately exit the company? I'll let you read these on your own, but they're thoughtful questions that get to our bottom line as investors. Calibration, it takes a couple of meetings to calibrate the board, and the issues where you will find conflict will be things like who should attend the board meeting, all management or just those who are reporting this particular meeting. Things like defining business operations. What is a sale? What is revenue recognition? And I've even been on board meetings where first-time CEOs thought the pipeline was the same thing as sales. So you need to be very clear about sales, about revenues, about bookings, and what those things mean. Otherwise, you'll have endless conflicts over the revenue model and the reports. So, committee structure. All companies have an audit and a compensation committee. Maturing companies also have a nominating committee to select new board members and an executive committee to take quick, decisive action for things requiring such, maybe even interim management. If you are planning an exit, you'll have an exit committee. If you're working on an investment, you may have an investment committee. It meets daily or weekly. And you may have an independent directors committee to write that independent directors letter, as I've said. The audit committee, the goal of the audit committee is to make sure that your financials are accurate and correct, and that you have the operating controls to avoid any kind of financial abuse, embezzlement, things of that sort. And they do happen. Ultimately, you'll also approve the final audit, meet with the audit firm. You will do things operationally like determine which level in the company gets to approve which level of financial outlay. It can be that managers and directors get a $10,000 or $15,000 signature approval. CEOs may get a $50,000 or $100,000 approval, but you should have a spending authority matrix. And of course, the audit committee will approve the option pricing of your stock options. And by all of those things, when I say approve, I mean recommend to the full board. I have seen lots of failures of audit committees. Sweetheart relationships between the audit firm or the law firm and the company, poor oversight, impaired operations. Right now, the biggest scandal in Germany is a company called Wirecard, which had $2 billion of assets that really never had. The company collapsed completely, leaving investors with a $4 billion hole. Ernst & Young was the auditing firm, and they're in deep, deep trouble now because of their failure to do really deep auditing. One of my companies, I was on the board of it, had a CFO in France, operations in the U.S. We have no cash in 6 weeks. We're 6 weeks to cash out. Because the CFO wife got cancer and was spending time with her, was not worrying about the company, was not keeping an eye on cash. We did a fire sale to IBM. That was the best option we had. Don't get in the situation where you're trusting, but there's no oversight. So just be aware, and I've also had situations of embezzlement where the audit firm thought they knew the CFO really well and trusted her, and it turns out she'd embezzled $250,000 in the company over the space of more than a year, and the audit firm was just too relaxed. So have an experienced outside director, not management, chair the committee. The CFO may recommend an audit firm, but it's the board's responsibility to validate and hire the audit firm and to manage the audit. Compensation committee, we design and approve executive compensation and make sure that that's aligned with company values. So if the best practices in the boards I've been on have often involved a highly leveraged compensation plan where there's some decent base compensation for everybody, but there are stretch goals, and the accomplishment of those stretch goals aligned with the company's annual business plan are where the real compensation hits. So we often have periodic bonuses that are based on company performance. We're the ones who approve executive hiring packages. We're the ones who approve increases to the employee option pool. And we're the ones who try to keep the CEO advised about current comp trends from our other companies or from reports like the Radford files, which indicate what different levels of compensation, with different levels of staff are being paid in terms of base, bonus, and stock in different regions of the company. So compensation best practices, I've said, a leverage model, pay for performance, have a company philosophy. Are you meritocratic and giving most of the leverage to people who have really performed, or are you more egalitarian? Do you have an episodic merit option plan once a year for true performers? I would avoid the sense that options are a natural right, refreshed every year. For winners and stars, yes, but you want to motivate people, not simply reward them for sitting in his chair. Exit options, if you're focusing on an exit, you may have a special option program during that exit where if you exit above a certain target, management gets a special option bonus, for example. So there are lots of clever ways to think about compensation, and this is where experienced directors can really help you align your compensation with the goals of the company. This is a typical bonus payout for a leverage company where if you achieve 100% of the plan, you get 100% of the bonus. If you achieve 110% of the plan, you may get 125% of the bonus, but it works negatively as well. If you achieve only 75% of the plan, you may only get 50% of the bonus. So this is a way of aligning compensation with what I call stretch goals. So we're going to turn now to our next sequence of Q&A.
Great, thanks, Ron. So our panelists can turn on their audio and video, and we'll dive into a few questions about building a board. So we'll start with you, Todd. So in an ideal world, the board composition, the relationships, the activity of the board are such that the CEO consistently feels that the board is a clear asset. But how do you approach a situation where the CEO may begin to view the board as more of a distraction than an asset?
Yeah, well, I'm sure this will just shock everyone, but every now and then, after the check clears, we begin to get the sense that a CEO might not be quite as excited about the idea of having a board as they first appeared to be when we closed on our investment. There can be big gaps in expectations, and so we need to talk about them. I think Ron drove home the role of the board, but sometimes a CEO comes in, especially early on, with an approach to the board meetings that feels more like a pitch, right? They're pitching us, they're selling us, they're presenting the best and most exciting aspects of the company. And there's a temptation to do that, of course, but it really is a waste of everyone's time, most so the CEO's. I think for us to be an asset for the CEO, the board needs to get the right information, be presented with the most important issues that the CEO is facing. So sometimes we can quickly get back on the same page by articulating this. Sometimes it's more challenging.
Okay, thanks, Todd. Clay, so it's not uncommon for there to be a debrief or multiple debriefs after a board meeting, maybe between the director and the CEO or between directors. And can you just tell us maybe how best to handle those debriefs and give feedback, potentially tough feedback, after a board meeting?
Yeah, I think that Ron actually put his finger on the most critical element, which is, I think, of trust. The whole process of providing feedback, of providing mentorship really needs to be built on the concept of trust between the management team, the CEO, and the board. There are a lot of ways to do that, but it does take time and it takes effort. It doesn't just happen by itself. I do think it's helpful on a lot of boards to have, as Ron suggested, a chair, and that chair becomes kind of the designated active conduit between the board and the CEO. And in situations, especially during performance reviews, I think it can sort of take some of the emotion out of the situation if there is a good trusting relationship there, especially important if you've got sort of 4 outside directors and just the CEO inside director. But you also talked about providing tough feedback, and that has to be done in a thoughtful, constructive fashion, and that can be difficult. I think that emotions can be strong, passion can be strong on everybody's part. Everybody wants to see the company successful, but they don't necessarily share the same vision for how to get there. But I would say one thing for sure: if that tough feedback isn't provided, that is a path to disaster. And I think that feedback is not intended, if it's done right, is not intended to alienate the CEO, but really to focus on enhancing the company's performance.
Thanks, Clay. Charu, maybe you could share with us some indicators of healthy boards as well as some red flags.
Yeah, I learned a lot from the presentation today from Ron, so I have a lot to internalize as well. So from my standpoint, I can talk from both sides as a board member as well as a founder. Is, number one is mission oriented. That, like, so for example, for Vital Exchange, we're serving the disability community. So it's really important that anybody we bring on board, whether it's a management team member or a board member, is aligned with that mission. Vision is a different story, because vision can come from a board member trying to solve a problem or unleashing an opportunity. So the difference in vision is not that significant, but difference in mission is. And we can see, take Facebook, for example. What mission does a social media network has to have, right? It didn't have to have a mission, but today you see how much trouble there is because there was really no clear value system and mission in place. The other part of it is that what struck me is the get board members for the right that are joining for the right reasons. The honor badge is a key component. Courting them, really saying, hey, you're the right guy. You've got strategic partner network, you have an investor network, you're a mentor, you have reputation, but if you're not going to give me time, then you come to the board meetings, your opinion is not very well founded. That also brings me to the other point, which is really there should be a rapport between early board members, early meaning the first 3 to 5 years of the company still, as you're going through the growth pain stages, that there should be communication beyond that formal board meeting. And that is what brings the trust. And I see this time and time again, I'm actually seeing this in one of the boards I'm on, is as the company starts to underperform because of COVID, for example, that fear of, am I going to be replaced? What's going to happen starts to set in, and the CEO spin starts to spin. You're not hearing the truth. And while you're trying to have a balance between understanding the company and being patient, you also have the job of keeping the team accountable and realize you haven't spent enough time. And that is, I'm just being candid about the situation. And then now I'm going and talking to everybody else, which I should have done, in which case I could have been a better board member for the company because I would have invested the time it needed on an ongoing basis. So, I think that's kind of an anecdotal example to validate few of the points that Ron and all the other panelists mentioned.
Thank you. So I think, Ron, actually a question that came in that you might be able to address quickly is, at what size do those more formal features that you mentioned, the standing board committees, the hiring auditors, when does that become more relevant or valuable?
Well, the functions are there from the beginning. It's still the board's responsibility to make sure that there are some financial controls in place. You may not be doing a formal, complete audit, your first year, but you still have to have ways to assure that those financials are roughly accurate. You still want to make sure that nobody can walk off with the capital of the company. So the board as a whole may serve in those committees. If it's a 3-person board, it may be, the full board that does that. I would say certainly no later than Series A, and because VC is going to insist on more formal operations. But best practice, if it's a best practice for companies to behave, later stage companies to behave as if they're public companies, it's good practice to build good governance in from the very beginning, and to treat these things as formal, to take board minutes at every board meeting, which is your best line of defense, even if you're a 2-week-old company. So it may be the board doing it rather than committees, but that doesn't remove the need for the function and the care. We're going to talk about this next.
Okay, great. Well, we'll go ahead and wrap up this discussion session so the panelists can turn off their audio and video, and we'll turn it back over to you, Ron.
So this is the fun stuff. This is why you as directors get paid the really big bucks. We're going to talk about the legal obligations of directors. So what's good governance? Well, this is my definition. The ability to make informed, fair, transparent, and accountable decisions efficiently, that means fast, for the preservation of the company and safeguarding the legitimate interests of shareholders and other key stakeholders. always in accordance with the law. This is what good governance means to me, and we're going to operationalize this in the next 10 minutes. We'll look at a director's legal obligations. So a director is a fiduciary, and a fiduciary is, quote, someone entrusted to manage the assets of others, acting wholly on their behalf without respect to the fiduciary's personal interests. And a fiduciary fulfills this duty with the highest standard of care. Think about your relationship with a bank. You may have a normal banking relationship. You may have a fiduciary account. What's a fiduciary account? It's an account where the bank is not pushing special instruments, special stock in which they have a vested interest. It is wholly picking instruments for you based on your best interests, where the bank has no interest in whether you're picking security A security B, or contract C. And that's the same thing in the status of a company. We are a fiduciary, we the board, managing the company without respect to our personal interests, but with respect to the interests broadly shared and the company itself. We operationalize this in three ways. One is the duty of loyalty. The duty of loyalty says that we're making decisions without regard to interests not broadly shared across the company. That is, we put our own interests aside. Bona fide, being a bona fide or bona fide, acting in good faith in interest of the company rather than self-interest and without violating the law. And finally, duty of care. We make informed decisions. And the way we demonstrate that to the court, in case we're ever sued, is documenting the discussions we had in the board minutes. We don't need to say what was said, but we need to make it clear that a topic was discussed. The board minutes shouldn't necessarily say whose term sheets we evaluated, but that we solicited term sheets and evaluated term sheets during the board is an important statement to make in the minutes. So the minutes should describe what, but not how, and that is our first line of defense. Our legal obligations and how do we protect ourselves? The basic way we protect ourselves is called the business judgment rule. Delaware court, which has more case law about private investing than any of the other chanceries, says that board actions are protected if we seriously believe that those actions are in the best interests of the corporation as a whole. Again, board minutes are important. And what's the standard of evaluation is, what would a reasonable person do in the same situation? And that's the question that a judge often asks, is what would a reasonable person do? Would they act like you have done? So how do we protect ourselves? We have evidence of duty of care, that we attended to our board package, that we had discussions, and that none of those discussions in any way infringed upon our loyalty to the company. I've mentioned earlier entire fairness, the transactions where there's an interested party like a board member involved potentially in providing a service to the company, or one of the directors' groups providing financing for the next round. This is where we issue those opinions. During a liquidation, our duties expand to creditors, not just investors, because in liquidation we very well may not have enough cash to satisfy all the creditors. So we need to make sure that we flip the switch and we're thinking about creditors as well. And in Canada, this often includes the community and all stakeholders, not just shareholders. We will inevitably face conflicts of interest between our duty to the company and all shareholders versus our duty to ourselves, our fund, our investor class. So what do? It's going to happen. First, you disclose it. Second, you recuse yourself by not voting and not offering opinions on that particular subject. If your angel group, if North Coast is the only group that's decided to provide financing or may have the most attractive term sheet amongst others, your North Coast investor does not argue the case, may describe objectively what you're offering, just to summarize the term sheet, but you do not argue the case, you don't debate, and you don't vote. And again, here's where the use of independent director voting and written opinions comes in. Liability. The business judgment rule applies to lots of situations if you demonstrate duty of loyalty and duty of care. But once we hit the red zone, the zone of insolvency, then directors are personally liable and usually not covered by the business judgment rule. When you hit the zone of insolvency, what that means is there's not enough cash in the bank to pay the mandatory things that companies need to pay in any situation, including a wind down. Those include employee wages and vacations that have been accrued, federal and state payroll and income taxes and disability taxes. If you don't pay wages to employees and you're going out of business, management and the board can suffer a 2x penalty in addition to those unpaid wages. So this is serious stuff. The red zone is the zone where you don't have enough cash and cash equivalents to pay these mandatory things. Now it gets complicated because this risk of insolvency, this entering the red zone, doesn't override your obligation to maximize shareholder value. And under the law, that's what directors are supposed to do, is maximize the value, the shareholder value. So Delaware often protects us when we're acting in good faith from insolvency creditor lawsuits like the landlord, but they don't necessarily protect us against red zone risks. And let's not confuse creditor lawsuits with insolvency risks of the sort we're talking about. So it gets even worse, because if we're on the board with VCs, their VC firm may have even greater D&O insurance, director and officer insurance, and may be willing to cover the VCs under a broader range of scenarios. So some VCs may say, I don't mind being in the red zone. I'm still covered. I'm not liable. I want that last opportunity to sell the company. I want that white knight to come riding out of the forest to solve our problem, even though it's a low probability. In that case, the non-VC directors will be exposed to greater risk, and that means us. Different states view these things differently, particularly about directors' liability for unpaid wages and state taxes. Check with your corporate counsel, the board's counsel, about what is going on in the states in which you operate. And I understand now that North Coast has the flexibility to do out-of-state deals. So just be aware of what different states are doing, particularly those who are not governed by Delaware. So don't we have protections? Well, of course we do. D&O insurance, indemnification. However, some D&O policies don't cover red zone. And if the company is out of money, they can't indemnify anybody. Indemnification means they pay themselves or via some insurance they've agreed upon. But if they're out of business or running low on cash, they may not be able to pay us. And so you may be unprotected. And the CFO may have canceled the D&O policy for cash reasons. You need to make sure that doesn't happen, that the D&O policy is still enforced. So the best defense is to get your corporate law firm, the board's law firm, with a strong venture stage practice involved well before you hit the red zone. It's not good enough to, oh my God, next week we may be out of cash, maybe unable to pay our liabilities. You need to be keeping cash flow on your radar all the time, and a particular at least 3 to 4 months before the red zone is anticipated. Get your corporate law firm involved and start putting in place policies to pay only mandatories and whatever it is else you need to do. So isn't the best thing to do to resign is just to walk away and say, I'm done, I don't want that liability? Not so fast, because if the situation, the red zone situation happened under your watch, and again, even resigning 3 or 4 months ahead of time is probably not good enough, you can still be held liable. The best solution that my lawyer friends tell me is if you're facing these issues, the best way to resolve this and to protect yourself is to stay on the board and work through the issues responsibly and rationally. And if you show good faith, if you're being fair to all parties, if you're really working to come up with solutions, there's a good chance that these issues will not hit you. But you're not absolved. I'm not absolving you from that responsibility. I'm saying the best chance is to be responsible and to be seen as being responsible and working through these issues with enough time to minimize their negative impacts. Who's affected by these? Directors are, and senior management may be as well. But Mr. CEO, Ms. CEO in the room, this includes you as well, both as a board member and as an officer of the company. Trouble zones. These are things we all have to worry about. It's balancing adding value and while maintaining our objectivity, not going native. So during the buddy system I've mentioned before, where I might take the VP of marketing under my wing, I want to be helpful and supportive, but I don't simply want to become the VP of marketing's defense counsel at the board. I have to maintain my objectivity. If objectively she's not doing a good job, we may have to take some action, even if I've established a personal relationship. The company is going to have lots of transactions with various vendors over the course of its first couple of years. It's going to be hiring a marketing organization, an audit firm. It's going to be hiring a law firm. And you don't want to be seen as taking those transactions for yourselves, your groups, your company, outside of your angel group. Personal relations with employees are great, but don't let them harm that objectivity. Under dissolution and wind down, which is the messiest situation, our duties shift to creditors and to the state to pay all those state mandatories. We want a D&O policy that gives us long tail liability for the things that D&O does cover. We may go into an ABC process whereby we hire a third party and we say it is yours to manage. The board will maintain oversight, but you day to day make sure that you can sell the assets of the company for the benefit of creditors. And remember again that VCs and angels may be entirely different in terms of risk profiles. I have been unfortunately on a few too many dysfunctional boards. What's a dysfunctional board? Where there's lack of alignment between board members themselves and between board and management. This often happens with first-time directors or first-time CEOs, where just the basic understanding of what our responsibilities differs substantially and is based more on prejudice and passion than it is on facts. One of the more important ways that we can get out of sync here between management and the board is with liquidation preferences. My best practice for angel deals is never to ask for more than the 1x liquidation preference for multiple reasons. One is because every follow-on round, the investors demand to inherit most favored nations treatment. And if you have a 2x liquidation preference and there are 4 or 5 rounds, you'll be standing beneath junior to $150 million in liquidation preference before you watch out. But where this distorts management and the board is because the larger the liquidation preference and the worse the economy means that chances are that the liquidation preference stack will not be cleared in an M&A situation. Remember that in an IPO situation, the liquidation preferences all go away, everyone converts to common. But in an M&A situation or a sale to a private equity firm or a buyout, the liquidation preference, if it's greater than the value of the deal, that means that management gets nothing. So management's going to say, why the heck should I work at all? I'm getting nothing out of this deal. I'm just going to walk away. Well, that's not the right solution. So you normally fix this with a carve out, where you carve out from the first dollar or the first dollar above a certain amount of money for management so they benefit from the exit as well. If you're in the Series C, Series D, you may have early investors who have lost interest, who are bored, who stopped investing because they could no longer keep up with their pro rata. And they may be on the board, they may have exercise influence, but they may be either not interested and bored or actively hostile because they're really upset with the way things are going. So you want ways, as I've said, like a 2/3 of our directors to get zombie investors off the board or to cash them out or simply to get them to go away. I've been in situations where we've had no management, where a crisis for one reason or another, including bad faith, forced the board to manage the company directly. That's happened to me 2 or 3 times. It's not pleasant, but it may have to happen. Let's say that we came in, let's say North Coast came in at $1 a share, your local VC came in at $10 a share, and the best offer on the table, and you really do need to sell, is $5 a share. The VC is going to be screaming and fuming and trying to block the deal. I'd rather see this company go bust than lose half my investment. And so at this point, you start horse trading. So different economic incentives can cause real conflict, even amongst friends. Maybe a lack of alignment between common preferred shareholders. You may have over-alignment between that originally independent director who has now become a buddy with the VCs or a buddy with management. So just be sensitive. The simple solutions, my simple solution is you go out for a mug of beer, and over your stein, you work things out. It's all based on the chemistry at the board level. So you want to get to know your fellow board members inside the board and outside the board as people, so that when issues like this arise, you can work as a board to work through them. You need to really understand the psychology and the sentiment of the people you're working with. There will be CEO conflicts of interest. CEOs, in at least most cases, are human too, and they have way more at stake than we do, emotionally and financially, way more at stake. We can't live without them because they're essential to our business success. So just be aware that CEOs, CEO behavior may at some points be even as irrational as our behavior as investors. They're afraid of being fired, so they'll hide or spin bad news. We may say, you're a great technologist, but you're really not a great business leader. Your own team says they want stronger guidance. And you may say, I'm going to bring in a president of the company or a COO to work with you. And the CEO will say yes, but will undermine directly and indirectly any hire you bring to the table. Just understand why your recommended hires are walking away. Some CEOs are less mindful of the dilution we're taking when they want every year an increase in the option pool, but the value of the company has stagnated and hasn't gone up. So we're being diluted every year as investors, but we're not gaining any of that back and increased in valuation. Try to make CEOs aware that this is a double-edged sword that hurts us, and as a result, we will be psychologically less in their court than we were before. Be aware of lifestyle CEOs who never want to exit, and this is one of the most important diligence items. You really want to understand what CEOs want. I've got one very close CEO friend who's told me in privately, Ron, I love my team. I'm trying to convince investors to invest, but I am never going to exit. And I've told her that she's not a candidate for private financing. And there are any number of CEOs I've met who say they want to exit, but in reality will like the lifestyle of being a CEO and love their teams. There are ways to compromise this, but to be aware. Other conflicts of interest, when there is money on the table, people go crazy. So these are all situations I have seen where a CEO colludes with buyers against investors and asks the buyers will want to approve an M&A deal because they know that there's a big bonus for doing so, and they know the buyer is going to demand that bonus be funded by the investors who will reduce their stake. There are sweetheart deals for execs joining the buyer's company. Again, will be prejudicial to the interest of investors. Will maximize management returns, what I call directed carve-outs, where a clause in the term sheet presented by a buyer will say, in addition to all things we've mentioned, we would like, of the $50 million going to investors, we'd like $10 million of that to go as a management bonus. Sometimes you will see CEOs who don't want to exit or don't like this particular exit plan because hope springs eternal. If they wait another year and investors put more money in, it'll be better next year. They'll undermine the exits, not doing diligence efficiently, holding things up, demoralizing the buyer. In some cases, not even disclosing they got a call for an M&A inquiry. We can fix all the problems I've mentioned except that non-disclosure of M&A inquiry, which is why We want to make sure the CEO and management interests are fully aligned with ours and they're safeguarded. Good things will happen under any situation so that we're all playing on the same team. But be aware that these things do happen. I have seen personally every one of them. The board has a key role in fundraising. We monitor cash and we determine when fundraising is needed. We approve the fundraising plan. We approve the uses of capital. We approve financials. We approve the valuation. And unlike the case of Theranos, we review investor presentations sent to potential investors. In the case of Theranos, the biggest scandal in Silicon Valley's recent history, the CEO projected $100 million of revenue when in fact the CEO knew that there would not even be $100,000 in revenue. So we want to avoid fraud because who's responsible for fraud? We are. We want to work with the CEO. We want to mobilize our angel groups, our syndication partners, the ACA syndication network, our friends to support the round. And our support of the round is pretty critical. Don't serve on the board unless you personally are willing to reinvest and to be a cheerleader for that follow-on investment. Use your network. Target old and new investors. Review term sheets. And again, it's the board that votes to accept a financing term sheet. And then it's the board that makes sure that we are responsible and do all the things we need to do to close the round. I have seen law firms screw up. We just weren't that important to them. They were very late in getting documents done. They were inaccurate in the cap tables they presented, leading us to take certain actions I'll talk about shortly. Again, it's the board's responsibility to manage this process. During M&A, it's very similar. Under Revlon rules, under a ruling related to the cosmetics company, our goal is to maximize outcomes for everybody, to direct the process. We hire the iBanker, we hire the law firm, we approve the term sheet, and the shareholders vote on the final transaction. And again, just like in financing, in M&A, we may need a fairness opinion. We have special obligations during M&A. And again, I'm saying this to you because M&A can happen at any time, even the first year of a company, as has been going on in Silicon Valley in the past couple of years during the arms race around AI. Revlon rules, we maximize short-term shareholder value rather than long-term interests, and we can even serve as an auctioneer. So when you sign a definitive agreement with a potential buyer, you are saying they're going to ask you for a no-shop clause and a non-disclosure clause. They're going to say you can't tell anyone about the deal on the table, and you have to stop looking for alternative deals. You can't shop our deal, and that's always fair. But can be the situation where a white knight has heard that you're for sale, rides in with a better offer. Under Revlon rules, you do not have to reject that offer. You cannot waive your fiduciary duties to shareholders. You have to look at that offer. So the best practice is to add a fiduciary out clause to any M&A definitive agreement or term sheet you sign, giving you the ability, if some party that you have not contacted, who simply approaches you without having been contacted before with a term sheet. So finally, in any M&A situation, have your law firm explain to the entire board and management team the duties of director's memo that they all maintain. And that will keep you clean and honest and ethical during what can be a very conflicted, very tense negotiation where directors who started off as friends may find themselves in tough positions. So common issues, the kinds of things that I've seen, every one of these is what you'll sign a definitive agreement with a buyer. And then before closing during diligence, the buyer will find any excuse to lower that price. And there is something in a definitive agreement called a MAC clause, material adverse change, which says that the buyer has the right to lower the price if there's any change to the company since the definitive agreement was signed. And one of the things that so for example, if you lose a major customer, if your revenue projections fall disastrously, Something that some very duplicitous buyers do is called sandbagging, where during diligence, they will find something that's in error. They'll find an error in what you've submitted to them, but they won't tell you. And they'll wait till late in the day, long after the definitive agreement is signed, say, oh, we found something during diligence. We're going to lower the price. Who pays for escrow and indemnification? Normally, there's a 15% holdback from any deal. And for things like IP protection, and other things that were not necessarily known at the time of a deal, and where the buyer can say, I'm taking some of that escrow to pay for these things. Who pays for the escrow? Well, management believes that this should come out of the wealthiest people around the table, the investors. But if you limit the escrow payment, whose money is held back, you will be unable to resolve any issues raised by buyers because you're not management. You weren't there at the time that things happened. So it's best practice, in my view, to have everybody equally share in the escrow holdback, so management has an incentive to help resolve these issues. Employee retention. Often there's a retention bonus for employees who stay with the company through the exit and who join the new company. Big contention, who pays for that? We investors should want the new company to pay for that. The new company wants us to reduce our take home from the deal by paying for it. So best practice, be aware of these and try to avoid outcomes that prejudice us. Question late in the cycle payments and option grants. I call this rats crawling out of the woodwork. In tight communities like Silicon Valley or Cleveland, word gets around fast that a company is about to be sold. And suddenly you will have consultants of all sorts show up saying, well, I had a verbal agreement with the company. I have 0.5% of the equity. I want to make sure I'm included in the cap table for the final distribution. Or employees who served a short time who believe they were entitled to options. Best practice is the minute you serve on a board, the minute you do a deal, the minute you start diligence, make sure you get as complete a cap table as possible, listing every potential beneficiary of any kind of exit. And if the company is not able to do this, is not able to do what I call cap table archaeology, then add a clause to your deal, which basically says that the investors in this round are held harmless for any errors, omissions, and other kinds of things that were not disclosed at the time the round closed. They should come entirely out of the pre-money, out of the existing team and the existing investors before you all signed on. But these things may happen. Demand documentation and demand that companies keep very accurate records on any claimants to any of this stuff. As I've mentioned, carve-outs, this is to align management with M&A outcomes. The typical range is 5 to 10%. It could be greater if you brought in a new management team or a new CEO who was not responsible for the high liquidation preference stack. They've joined the company and there's a $100 million stack. They should be held harmless, but the existing management team that made that stack happen, they should not get such a sweet deal. So 5 to 10% of the exit value, no double dipping. They don't get paid for options in the money, and for the carve out, if suddenly the options are in the money, the carve out goes away. But with the in the money options will be diminished for every dollar you pay out in the carve out. Many ways to do carve-outs, sometimes from the first dollar of M&A value. A second way is you establish a floor that says we want management investors to at least get, let's say, 50% of their cash back. Any dollar above that is equally shared with management towards the carve-out. Most investors, particularly VCs, hate carve-outs. And when you do a carve-out, it's a signal that the company may be exiting for less than a liquidation preference stack. This is a very negative sign to give all the investors, but in fact, it may have to happen if you want a reasonable exit. Finally, carve-outs, the board recommends, but because this is a change to the capitalization structure shareholders must approve it. I want to begin to end this section with just one horror story. I sold a company to a well-known Fortune 500 company in the networking communications business. The buyer demanded unlimited indemnification for any issues, including unlimited IP, for forever. They also wanted a 5-year escrow for any issue. And the buyer claimed, yeah, we do deals all the time. This is standard practice. We pushed back and saying, you know, we can't distribute any cash to any of our fellow investors because this is unlimited indemnification forever, which means there is no exit for us. So our law firm, which was one of Silicon Valley's best, had done tons of deals with his buyer. And our lawyer pushed back and said, this is garbage. We've done many deals with you. You've never asked for this before. You're simply trying to bully a young company. We walked away, and the major buyer caved. So having a smart lawyer on board is super important. You may need what I call an accelerator, an excavator, or an undertaker, because you may be in an extreme situation we need outside help. Accelerators, in this view, are really outsourced business development or sales management, and the company is not able to really run a good sales operation. An excavator is a turnaround firm that is going to provide interim management to figure out what's good about the company, whether it should be sold or continue to an operation. And I've had a number of very pleasant interventions from turnaround firms. And finally, you may need an undertaker, which is a wind down firm who can sell the assets of the company. In any case, all of these firms, turnaround firms, shutdown firms, need runway too. They need 6 months or more to effectively do anything. So don't be bashful about suggesting you might need some help. You can always not sign the deal at the last minute, but at least be prepared if you need to. Again, resigning won't help you. Involve company counsel as early as possible. We're now going to turn over to the panel discussion again.
Great, thanks, Ron. So for our panelists, if you wouldn't mind turning on your audio and video, and we'll start with Todd. So Todd, how do you deal with board conflicts due to possibly different directors, differing economic interests?
Yeah, well, I like how Ron explained that everyone's human here. And I think that's a good place to start. Depending on how early you invest, the share price you invest at, or how deep your pockets are, you may have a slightly different perspective. And these perspectives are all potential conflicts of interest, so they need to be acknowledged and managed. But to the point of everyone being human, I've personally seen situations where directors, for a moment or two, just seem to forget which hat they're wearing, right? The investor hat or the board hat. And I think it needs to be called out, but ideally with really strong diplomatic skills, not a blunt instrument. So there are times I've had success in these situations just by reflecting back to the person what I think I'm hearing, and tell them perhaps I appreciate it. It's been 7 years since your initial investment, and I know it's more than what you signed up for, right? You acknowledge it, then you kind of put the blame on yourself. But as I put my blinders on, and I think about the broad interests of the company, it's pretty hard for me to get around X. And it's a way of just giving people a little gentle pushback to what they should be doing. I should acknowledge that that's more effective on individuals than it is professional venture capitalists, where they have to report back to their partner meetings. But that's, I think, one of the ways you can approach conflicts.
Okay. And Charu, so as you're thinking about these governance considerations Ron just shared, what do you see as some of the most valuable characteristics of a board member?
Yeah, so I think I'll again reply from a perspective of a very early stage board. I've been on the other side of the table reporting into a board and being a founding board member, but this is the first time in the last year that I've been a board member without being part of the management team, which is a very different place to be. And I was laughing when Ron was saying about his NIFO principle, nose in, fingers out. I did nose in, fingers in. And two things happened. One is I was meddling in a business that I really wasn't, capable of running it day to day, or even shouldn't be. And I mistook that governance for, here's a problem, it's my job to solve it, which is my mindset when I'm actually part of the management team. And I had to learn that and bruised myself in the process. But now I understand that governance doesn't mean interference. It doesn't mean you're going to go step in. There's that balance of being kind and understanding and guiding, as well as making sure that the team is accountable from all of the comprehensive governance and legal standpoints that Ron pointed out. And also understanding your strength as a board member, because the board is a team of people that have different strengths. So for me, I'm actually a founding chair of a board. I know that all of the things that you mentioned just went over my head. It's like I can say that, but I'm not going to remember it on a day-to-day basis. So I really do need to attract other members. We're actually in the process of building the board now, need to really attract other members that are going to be very cognizant. They're highly experienced in making sure that we're doing the right things from a company standpoint. So totally appreciate that. But I do think that from a governance standpoint, governance does not mean control. And I think that's a very important recognition from a board member.
Okay, thank you. And Todd, or sorry, Clay, maybe just quickly, you could give a reaction to what you would do if you're a board member in this situation. So you find yourself in a situation where the CFO says the business is almost dead. It might be time for an orderly shutdown, whereas the CEO is saying, but we might receive a term sheet in the next 3 weeks.
Well, I hope it's not coming as a surprise, because that sure suggests that there's a real fundamental problem with the whole management team. I think that there may be a little bit of the question of, are we in that zone of insolvency, that red zone that Ron was talking about? To be candid, in the 24 years that I've been doing this full time, I've never actually seen legal counsel specifically call out this zone of insolvency. And it could be because the majority of the situations that I've been involved with have been Delaware companies. And I think Delaware law gives a lot more protection to board members. So I think that, the key thing is obviously, why is the company out of cash? And I think a lot of people sort of say, yeah, okay, 3 weeks, I'm going to get a term sheet. Yeah, well, let's say you get a term sheet in 3 weeks. That means it's going to be another 3 to 6 weeks after that by the time you get documents pulled together for new investment, assuming you could even get it, you get investors lined up and you get things closed. So you're really talking, do you have 2 to 3 months worth of cash? And assuming you don't have that, I think that's where you get into these questions of where do you go from here? And I think the biggest question in my mind in a situation like this is, does the company really have any market opportunity? Even if it tried to pivot, is there an identified market opportunity for the business? Or is this really an issue of too much overhead? And you have to just move much more quickly to change the overhead structure and determine whether the company is worth salvaging. But in all cases, you get into this tight timetable. I think Ron's admonition to get counsel involved is very much spot on, because you're walking into a challenging period regardless of legal liability. You got a lot of big decisions to be made, and I think depending on your state, you've got a lot of issues to be aware of from a legal perspective. So it's not an easy thing to sort of have one response for, but I think that you got to move quickly.
Okay, thanks, Clay. Well, we'll wrap that up then, Ron, and we'll turn it back over to you. We'll turn off our audio and video.
Great answers, all of you. Really, really intelligent answers. So best practices in working with your board, obvious things: review the board package, don't be a drive-by board member, attend in person, haha, under COVID, that's hard. But try to be focused during Zoom on that board meeting, and always have an executive session. Delegate a member to give CEO feedback, and stylistically question thoughtfully in public, and any tough challenging, do that in private. What does the CEO want from us? They want us to take that midnight phone call, to be engaged, to give honest feedback, to be experienced problem solvers focusing on solutions. They want access to our network. They want access to our other companies. How do your other companies deal with this? They want us to be good mentors and team players, and not be masters of the universe jerks, the way, unfortunately, many VCs can be. They want us to be proactive ambassadors and to act with integrity, and really to serve the interests of the company proudly. What CEOs should do is take an active role in assembling the board, aim for excellence, diversity of experience, avoid cronyism. Don't bring your father-in-law on the board. The CEO and the key board members meet regularly outside the boardroom. We get to know each other. We get to trust each other. When there's a crisis, if we haven't developed trust, it may be too late. So build that trust early. Before the meeting, the CEO should engage with us, go over the agenda, tell us bad news, and tell us what the decisions that should be made at the board meeting are. What do you want, Mr. CEO, Ms. CEO? We walk out of the room. What will you feel will have made a successful board meeting? The CEO should pre-sell us on plans, on pivots, on hires. Again, no surprises. And one discipline I would like every CEO in this room to do is to learn to think like an investor. Understand how we calculate reward and risk. Understand what returns we're looking for and why. Understand what moves the needle for us as investors, so that we can move together in the same direction. Please do not obsess about compensation. You will be taken care of if you are a responsible CEO with a responsible board. What we want from you: view the board as an engagement, as an opportunity, not as a nuisance. Use us really as a strategic sounding board, people you can talk to. No surprises. There's no penalty for bad news. There's lots of penalty for spin and hiding news. I'm going to say that again. There is no penalty for bad news. As long as you fully disclose what's going on and try to do a root cause analysis and have at least a first order approximation of a strategy to deal with it. Keep up your calendar, keep up your D&O insurance. Distribute things 3 or 4 days ahead of the board meeting so we can have a timely way of looking at them and help us resolve conflicts of interest. Hire an experienced corporate law firm with what I call an emerging companies practice. Remember that the law firm represents us, the board, not the CEO, not us as individuals. And it's the board that hires the law firm. I have fired law firms for these reasons: incompetence. They couldn't manage a financing round or a cap table. They never enforced best practices on us. They never enforced duty of care on the board. They had sweetheart relations with the CEO or with individual directors, or they simply didn't pay us attention. So it sounds strange to fire a law firm, but these are all great grounds for doing so. Make sure you get competent legal counsel and are not taken for granted. We're living in the worst crisis that I've ever lived through, and I expect many of you feel the same way. What do we do in time of COVID and pandemic? Well, the board should be aggressive in setting the agenda with the CEO, making sure that we're aware that cash is king. Don't be afraid to plan and replan and replan. As I like to say, maybe it's time from focus on selling to Hilton to selling to Charmin. Focus on where the market is, not where we'd like it to be. We need to be wonderful mentors. We need to do that honestly, but also with empathy. Our CEOs are facing the same health risks we are. Their families are in trouble. Members of their families may be unemployed. They may be living in just hell. So make sure that we understand that they are mortals and really struggling. But in all of this, do so honestly and build a good governance culture. Bring your law firm to every meeting, which they're obliged to do anyway for free. Have regular board meetings, take minutes, do all the basics. So the bottom line for angel investors is build trust with management before the crisis occurs. Remember that board service isn't a merit badge. Proper governance builds resilient companies. We educate companies in how to operate the best ways. And so do that, mentor well, help the CEO grow. We're asked earlier about how often it is that we need to replace CEOs. Well, except in the situation where we have a tech CEO who is never going to become a business leader, we want that CEO to stay on board. We want the CEO to survive from formation through exit. Doesn't always happen for a variety of reasons, but it's our job to help that CEO grow. Be exemplary fiduciaries. Don't avoid conflicts. Find trouble spots early and address them. Focus on adding value and be a great ambassador. So if you're facing a crisis, you want to be an exemplar of bad governance or good governance. Bad governance, the board isn't really focused. It's in conflict. It's a drive-by board. It's self-dealing. It lacks team spirit. Doesn't anticipate anything. It couldn't manage its way out of a paper bag. It may be even allowing the company to do illegal company activity because it needs cash. And it's not working hard to prevent a meltdown. Good boards and good companies have a crisis dashboard and a strong agenda. And they live and die by their ethos of duty of loyalty and duty of care. They use independent directors well. They've worked very hard to work well together. They provide oversight and monitoring through a strong board. They're not simply rubber stamping management. And there's a strong governance culture and trust between board and management. As I wrap up, remember in time of crisis as directors, our roles as fiduciaries and stewards are essential. Not just to help our companies survive, but to thrive. And again, you know as well as I do, the stakes, my friends, have never been higher. Thank you.
Fantastic. Thanks, Ron. So before we wrap up, I'll ask our panelists to come back on one more time. And I would like to start with a few questions. So maybe Clay, how does the board role change in a dynamic situation like COVID?
Actually, I think Ron captured that pretty well. I think fundamentally, the responsibilities don't change. What does change, I think, is the urgency with which the contingency scenarios have to be developed. We have to understand where the risks are, whether they're in the marketplace, whether they're with our funding sources, whether they're within our own organization. And I think the vital role of the board is that it has to be sometimes painfully objective and realistic about the environment that we're in. Other than that, I think that the board task really remains the same.
Okay. And Charu, maybe you can share some thoughts on this concept of mentoring with empathy and honesty.
That I can do. So I think that I do think that as a board member that is also an entrepreneur, that's one of the probably the most unique things that I could bring to the table. But then to Ron's point, this is a time where empathy is just so important because it's difficult and no one can pull a rabbit out of a hat in a short time because this is not something that we anticipated. So one of the things that I do, and I've learned over time that I would appreciate my board doing for me is not to be reactive and to send an inflammatory email or a showdown at a board meeting, in which case it creates a culture where board becomes the bad cop and the internal team learns to fear the board. And I've been in situations also where the executive team tells the engineers, hey, we've got to do this board presentation because otherwise things are going to be really difficult and you won't get your bonuses. So this board is seen as this really negative fearful, a fear-inducing entity. So from that, I do think that empathy is important, because when and that transparency can be lended to the inside team as well. Teams love it when board members are there and they understand, they know the names of the engineers. And empathy is not just to one person. It is also to show that you guys are working really hard. To that engineer that's working 16 hours a day, a board member that says, thank you for moving this needle forward or solving this problem, can be a huge way that you can demonstrate that you care and you have skin in the game. The other part also, very importantly, is when there is a big problem, and usually big problems, we started this with hiring and firing CEOs. If there's an executive team member or a CEO that needs to be transitioned out, boards must be empathetic to that, in the sense that transitions have to be thoughtful and quick. I've seen this many times. One of the signs of a bad board is, I call it the butcher. I'm a vegetarian, and like the butcher, bad butcher, cut, and this team is bleeding everywhere, and you still haven't made the transition, and everyone everywhere knows that this is going to happen. And you have this very fearful, protective leader that has now been pushed beyond the limits of psychological distress, versus really saying, let me sit down with you, let me take you to dinner. Find that board representative that is the most empathetic and connected with that individual, and explain to them why this job is no longer the best suited for any of the stakeholders around the table. I do think that at some point, most people are effective and they may transition to ineffective, and we owe them that plan. We owe them that objective SWOT analysis. We owe them a list of things that they've done right and what they could be doing and why somebody else is better for the job. I do think that the quick transition is really an important part of showing empathy.
Great, thank you. Todd, this may be a one or two word answer, but reinforce for us one more time for everyone, who is the director working for?
Well, the short answer is it's the shareholders. But in hearing all these comments, you appreciate just how hard of a job being a director is, and how dynamic it is. And I guess if I were to leave, kind of think of this as how you build a relationship with a CEO, but still be objective, how you believe in the vision, but still be realistic. While new challenges pop up all the time, and I think we know that CEOs have the weight of the world on their shoulders, but sometimes as directors, it can feel like we have the weight of the world on our shoulders too. And I guess my wrap-up thought would just be that it's important for all of us as directors to have a personal sounding board outside of the boardroom. In a group like North Coast or a venture capital firm, it can be other experienced board members. But that kind of network of people with board skills, but outside the specific dynamics of the boardroom, can really be crucial in helping you stay objective, helping you uphold your fiduciary responsibility and appropriately represent the interests of all shareholders.
Okay, thank you. Well, I think that is all the time we have. Ron, if you wouldn't mind advancing to the next slide. I think it's just our closing wrap-up slide. But, a few closing comments. A couple thank yous. We want to thank our sponsor, PNC, again, for supporting this event in our Investor Insight series. We want to thank Ron and the Angel Capital Association. We want to thank our panelists. And, with all those thank yous, I guess everyone's just going to have to, imagine a thunderous applause coming in from our virtual attendees. But, thank you to everyone for attending as well. Just a heads up, you will each be receiving a follow-up communication after the event. It'll have a few things in it. It's going to, number one, include any additional responses to questions we weren't able to field here during the breakout discussion sessions. We're also going to include a survey asking for your feedback. Please complete that survey, that very brief survey. We will also include in there, share the recording of the event and the slide deck. So if you do know of others that serve on boards or are investors or founders that want to see their boards being successful, should be all investors and CEOs and founders that please feel free to share. That will be included in our follow-up communication. And just finally, we at North Coast Ventures, we're always looking for ways and opportunities to engage with more founders, with more investors, with more potential partners. So if you're interested in learning more about how our organization works, we will include contact information for different members of our team and how you can connect with us in our follow-up communication as well. So again, just thank you to everyone, and have a nice evening.